nationally, we had a clearance rate of just 43%. Both Sydney and Melbourne have experienced price drops over the past quarter of more than 2%. This is worrying, of course, to anyone concerned about the value of their home.
For houses, Perth still has 20% left in it in terms of capital growth before it hits its affordability ceiling for houses, and almost 50% for units.
The big one in the news at the moment here in Western Australia, Lachlan, and there was some R code change to the WA property market.
It's going to allow an extra 50,000 more residential properties to be subdivided, which in theory is true. In reality, it's not so simple. But have to see interest rates go up to about 7.2%, so another sort of 4 rate rises, to put it into simple terms, before it hit that affordability ceiling. If you buy a property in some of the speculative regionals in Australia, I think they'll be worth potentially the same or less in 10 years' time.
Do you think that the slowdown is sentiment driven, or is it the increased stock at the moment?
That's definitely sentiment driven. We're in a period of time of mass uncertainty, Reece. So I think the quickest way to get debt free is by taking on more debt, which sounds counterintuitive.
You're listening to the Follio Property Podcast. I'm Reece and I'm here each week with my co-host Lachlan Delahunty. Lachlan, last one for your trip in Sweden, mate. I thought we'd make things, we've got a big build-up of Q&A that our loyal listeners have been sending in over the last couple of months. We haven't addressed some of these in some time. There's a lot going on in each market as well. So I thought what we'd do today is let's do a Q&A. Some of the most common questions we get through the podcast, through our emails. Also focus on some particular areas as well, because we do get a lot that are focused on each state. So let's kick it off with Perth, because that's actually been one where we've been getting a lot of feedback. People want a Perth episode. Just so those that are aware, we will be doing a Perth breakdown in the next couple of weeks with yourself and Trent Fleskens. So there is a Perth-only focused episode coming up. But let's kick off with a couple of quick-fire ones that we can answer before that episode. The big one in the news at the moment here in Western Australia, Lachlan, and it probably happened just as you went on leave, but there was some R code change to the WA property market. For those, it would be good to get a bit of an understanding from just briefly from your perspective, what the R code changes mean, what are an R code, and how does that impact infill development in Western Australia, which we definitely need.
Yeah, it's massive. I think the headline median that John Kerry was going for, it's going to allow an extra 50,000 more residential properties to be subdivided. So, which in theory is true. In reality, it's not so simple. But essentially, what the R codes are, Reece, is the minimum square meterage required for an allotment to be subdivided. And currently, for an R20, which is a very common R code in residential suburban areas, probably the most common coding within Perth and Western Australia, it's requires a allotment to be a minimum of 900 square metres before it can be subdivided. And we know in Perth there's a lot of properties between that sort of 700 and 900 square metre. Probably the most common in the more established suburbs when you think of areas like, Wembley or Duncraig or, blue chip infill areas typically are difficult to subdivide. Now that's been reduced down to 700 square metres. So it's going to open up a lot of opportunity. And I think for those that are looking at a post-budget solution for a more mum and dad to sophisticated investor, I think this strategy is going to work really well, where you can still stick to quality, blue chip assets in areas, but you can also participate in developers. So I think it's going to be a great strategy for those looking to get a tax benefit as well. And we spoke about this pre and post budget, Reece, what to look for, and we know if you go and buy a property, hypothetically, say in Wembley, for 750 square metres, you can now subdivide that into 2, build 2 new dwellings, and you're going to get the capital gains and the negative gearing benefit on those 2 assets. So it opens up a whole range of opportunity of quality stock, stuff that I truly believe in is a good investment, both short, medium, and long-term assets. There has been an argument against the Greens. They don't like it. They think it's chopping up more leafy suburbs. I disagree. I think there's really good infrastructure in these suburbs. People want to live there. There's good amenity, and if it's done right and tastefully, these assets are good value and hold their value longer term. So I do think this is probably the best policy that I've seen to bring on the right type of supply, and I think we'll have a lot of investors take this opportunity up because of the tax benefit you get with this as well.
If you're serious about property, you need better inputs. PropStack is where our chief economist and research team puts everything together. Our leading investment reports, our suburb level data, and a weekly market update on what's actually moving. It's the same research our advisors work from, and you can get access now. Scan the QR code and click the link in the description. Lachlan, advice on Perth. How will it hold up once it hits the $1.1 million price mark? So we're edging closer towards it. We're not there yet. The question asks, how will we sustain the price with no salary increase, inflation's up, people are stressed out, uncertainty in the world, such as the war, etc. There's probably a lot more uncertainties as well post the war. But yeah, from your perspective, Lachlan, how does Perth prices hold and go into that $1.1 million mark?
So to unpack that, we've got to go back to the fundamentals. It's all supply and demand, and said this before in the podcast, if you take out recency bias in terms of what's happened in Perth over the last 5 years and just looked at the raw data, it's still the best market fundamentally from a data point of view in the country. So all recency bias in terms of how it's performed over the last 6 years aside, an international would come to Australia, look at the data and invest in Perth because there's more people moving into the state than ever before. It's got the second highest population growth in the country, and where it's significantly undersupplied and building less than all the other states. So from a pure supply and demand, there's more people coming in than we're building homes. That is a good market, short, medium, and long term. To answer your affordability play, if we hit and when we hit 1.1 million, what happens to the market? To give you context, the ceiling in Perth, there is still a lot of runway in the Perth market currently from an affordability point of view. So to give you context, where we sit today, Reece, and hypothetically an interest rate of 6.1%, the runway in terms of the price ceiling that Perth would have to hit before it runs out of its affordability. For houses, Perth still has 20% left in it in terms of capital growth before it hits its affordability ceiling for houses, and almost 50% for units. So that's that's not including any potential wage growth, and that's not including the long-term futures of interest rates improving. So for us to hit that ceiling, we'd have to see interest rates go up to about 7.2%. So, another sort of 4 rate rises, to put it into simple terms, before we'd hit that affordability ceiling for houses. And there would still be a level of runway for units. And then if we looked at units, we'd have to hit, well into sort of 9-10% interest rates before we'd see affordability ceilings on units. So to give you comfort, do I think we're going to see the level of growth that we've seen for the last 2 or 3 years? No, I don't. But double-digit growth in any market isn't sustainable. What is sustainable is typically about 0.5% growth per month. You net that out over the long term, and you're looking at about 6% growth each year. That is sustainable growth, and that's the level of growth that I think we'll see Perth over the short to medium term because the fundamentals are very strong. It's very different to what we saw back in 2008 to 2014, that sort of boom bust economy. And the reason for that is we had a mass exodus in population. We're not seeing that at this point. We had a massively oversupplied market in 2014. We oversupplied the market by about 110% when we look at the surplus level between how many people are moving in and how many houses we're building. We're still under building, and because of construction constraints, particularly in higher density apartments, when it's very hard to foresee an oversupply coming in the short to medium term. So that's why my view on Perth is more bullish than other markets, is because fundamentally we're undersupplied in the short to medium term. And we don't have an affordability issue yet, which will surprise a lot of people, but our wages are higher than that of anyone else in the country.
The next question is it's a similar question to this one, so I won't ask the question, but there's a comment in there that I want to get your feedback on because I think it'll address their answer as well. Essentially, it's the same sort of concept. Are we at the peak in Perth? The big one is, you guys mentioned these supply stats, which are spot on, but on the ground feel in Perth feels like we've peaked with listings now up to 6,000. We were talking, historic lows under 3,000 listings there for a long period of time. Do you think that the slowdown is sentiment driven at the moment, or is it the increased stock at the moment?
No, it's definitely sentiment driven. We're in a period of time of mass uncertainty, Reece. So the reason Perth is still getting growth during such time of uncertainty when every other market in Australia is essentially having negative declining house prices. Perth still is in the positive. And the reason is because we are still significantly undersupplied. If we weren't undersupplied, I think Perth, like every other market in Australia, would be seeing negative house declines week by week, month by month. But we're not seeing that. So we're in a period of time nationally where sentiment is at record lows. And this period of time has been from budget. It could be for the remainder of the year. I expect things to improve in the spring once there's some positive news. So yes, listings are increasing in Perth. There's more supply in the market than there was 3 to 6 months ago. Balanced market in Perth is somewhere between 12 and 14,000 properties. We're now in the 6,000. So historically, we're undersupplied. But we will see demand return to the market when there is more positive sentiment nationally. And that's going to be driven predominantly, I think, by interest rates. And at the moment, there's still a level of uncertainty whether they're going to go up, down, or sideways. We certainly don't think there will be a reduction in interest rates this year, albeit we've had a guest on recently saying there's going to be 7 interest rate cuts before the end of next year. So I think once the sentiment nationally starts to change to more positive dialogue, you'll see Perth continue to perform at levels that are sustainable, which isn't double-digit growth year on year. It's typically between 6 and 7.5% annually.
The last question, I'm going to round it out. It's not necessarily Perth, but it's WA focused. And the reason I brought this one up is we get this question quite a lot. Hi, Lachlan and Reece. Curious to hear your thoughts about the property market, particularly the investment market in Busselton, Western Australia. So for those that aren't familiar, regional town, a couple hours south of Perth. Whilst regional, it has an airport to support FIFO employment, huge population growth, Perth spoil over, holiday rental potential, and a gateway to the greater southwest. Lachlan, what's your thoughts now on this particular region, and has your thoughts changed post-budget with no negative gearing benefits from an investment standpoint?
And the fundamentals are strong. It's a very undersupplied market. And as you said, it's the gateway to the southwest. I have probably more concerns over the more lifestyle assets further south of Busselton. I do think the holiday type home properties will suffer. Busselton is slightly different. It's got a very strong population base without the absolute reliance on tourism in terms of that short stay accommodation. So I think fundamentals are strong. All those things that have been mentioned in terms of the airport, the longevity, but more importantly, the government have come out and essentially announced its future funding spending on the major regionals, and that's inclusive of Geraldton, Kalgoorlie, Busselton has been included in that. So we know the government are going to support that market as a key hub in the south. So what does that mean? It means a lot of money is going to get pumped in for infrastructure. That means, public transport, schools, medical, all those sorts of things. So if we know the government and we know the Western Australia government has a lot of money to spend, and they're going to back that as the regional hub of Western Australia in the southwest, then fundamentally from a medium to long term view, I still hold strong, still hold that market in strong regard. Don't expect the same level of growth that you've seen over the last 3 to 5 years, because that was built on a lot of sentiment around holiday homes and tourism of the like. But I think it will hold its value and see modest growth over the sort of coming 5 years.
Next one, Sydney-based question, but it goes probably generically for anyone in Australia potentially. Hi team, my wife and I follow your podcast and can't rate the information you provide high enough. Had to get that one in there. We are based on the lower north shore of Sydney. Within the last week, we have noticed a new trend with advertising properties. They have been listed with a price. Have agencies changed their strategy and realised people won't bother going to a listing when most are listed with lower prices to find out that the price sells for much higher, resulting in disappointing buyers? So I'm assuming this is a change in tactic in the Sydney market. Does this have anything to do with a falling property price and negative sentiment?
Really good question. So what you'll find is, this is where Victoria is very different. They have to legally disclose a price, and if it's not within sort of the scope of what they expect, they can get fined. But I think the reason you're starting to see this is taking place not only in New South Wales, but Queensland and Western Australia. I've seen a massive uptick of advertised price. And the reason is there's more stock available and there's less buyers. So we need, the agent is trying to capture attention and trying to get as many genuine interested buyers through a property as they possibly can. And when you're in an undersupplied market, you can put up any property. And the idea of that, the agent just wants to fetch as many calls as they possibly can, because they want to see if you've got something to sell. But there's a lot of time wasting. And in this market, people aren't just shopping around for the sake of it. People are only interested in properties if it's going to suit their needs. And if they have to make the effort to make a call to an agent, will likely won't call them back to try to get a price guide, there's an opportunity that potentially agent will lose that potential buyer for that property. So it's really cutting through the noise. And I think it's a good thing for the industry when it's very transparent between sellers and buyers. Here's our price expectation. What you'll find though, and what we're starting to see a little bit of is underquoting. So they'll put up properties with a price guide, hypothetically of 1.1 million, but they have no expectation to sell that property for anything less than 1.2. And that's when it gets a little bit deceptive. They're trying to get you through the door as a buyer, because at 1.1 you go, geez, that's very cheap. That property would have been 1.3 12 months ago. Let's go through. That sounds like a really good deal. And then the agent's trying to engage you into the home open so he can do what his job is to sell to you, to get you to fall in love with that property and get you to pay 1.2 for that property. So yes, it's a good thing. Be a little bit skeptical, because you'll start to see a lot of underquoting take place to get more buyers through.
Next one is in Melbourne. The viewer asks, are you saying outer Melbourne house plus land packages are a bad investment even for long term, say 10 years? So I guess this particular listener is looking at a medium hold, I guess, for a house and land package area. What's your opinion on that, Lachlan? I know, you've mentioned multiple times through the podcast over the last 12 months, our thoughts on those outer fringe areas. But if there is a medium to long term hold, does that make sense for certain clients?
No, it doesn't. And I'm pretty blunt on this. And the reason is it's because you're talking about an opportunity cost. So yes, real estate and property in general, if you hold a property long enough, you are going to do okay. So if I buy a property now, pretty much anywhere in Australia, and I hold it for 10 years, I'd like to think it's going to be in better shape in 10 years' time, with the exception of regionals. I think if you buy a property in some of the speculative regionals in Australia, I think they'll be worth potentially the same or less in 10 years' time, but that's another conversation. So the reason, and I'll speak about this a bit on the podcast, you buy in an outer fringe area, and Melbourne is the example you used, there is supply in that market for the next 100 years, because there's so much land that can be developed. So you are not building or buying a property that has any significant level of scarcity. Yes, if you buy something, if you look back and you had a bought in Pakenham, which is the out of east, 15 years ago, yes, your property is worth more now because they've built out through you, and it's probably considered almost infill now, right? But the opportunity cost of that money, if it had been put into another asset class or another market that has more scarcity, be that it's landlocked, it's in a market with more owner-occupiers and investors, it has significantly outperformed that asset in Pakenham. So you might have bought something in Pakenham 15 years ago for 450,000 and it's now worth 750,000. But at the same time, you could have bought something in a ring or say a home in Geelong for 450,000 in an area like Geelong West or Newtown, probably not Newtown, in a house like Geelong West, and that property's now worth 850 to 900. So, which when you look on your cash return in terms of how much money you put into the deposit, plus your gearing and then your exit, and you net that over 15 years, you're talking about probably 2 to 4% difference year on year compounding growth compared to two. So sounds like a detailed way to answer a pretty simple question, but it's not a bad thing. I think the worst thing you can do in property is do nothing. So by buying an asset and holding it long term, you'll likely do pretty well. But it's the opportunity cost of that money. You have X amount of chips you can play with in terms of your borrowing capacity and X amount of chips in terms of deposit. You want to put that into the best performing asset you possibly can for the budget you can afford on the data that we're looking at today. And the data I'm looking at today does not suggest a house and land package area on the outer fringes of Melbourne is the best use or the best allocation of your capital.
This segues nicely into the next question as well, because you did reference it there when you were comparing assets on a house and land package perspective. The viewer asked, would Bendigo Ballarat be considered in a similar market like Geelong in terms of proximity to Melbourne, metro, regional? So, we talk about this a lot on the podcast, the difference between regional areas and we may have made it up, but metropolitan regionals where it has the clear access into a major city hub, particularly around an hour and a half until the access. What's your thoughts on Bendigo and Ballarat? Do you put them in the same market as Geelong? And if so, why?
Yeah, that's the one. So yeah, these commutable regionals that we talk about, or metropolitan regionals, yeah, they are absolutely within that realm of Geelong. I consider them very commutable, and that's the whole point. You can, and the reason it needs to be commutable, Reece, is because of it's to do with the income. So why we look at Geelong as an example is because its affordability index, or its price to debt ratio, it's going to be higher than a market like Mildura. And you're like, okay, what does that mean? Well, it means people living in Geelong can buy a home for $800,000. And if they are on Geelong wages, that's going to be an expensive property to hold. But if they're on Melbourne wages, which is often the case for these commutable regionals, is they're on city wages, so they're on Melbourne wages, but they live in a regional. And you can't generate that in a place like Mildura or a place like Ararat or these other areas in Victoria, where they're going to be on regional wages, which is typically a lot lower than major metro wages. So it's all about that income source. And somewhere like Geelong, you'll see a large portion of that population commute every day to Melbourne to work. They get that increase in wage, which means their affordability is much higher in Geelong, so they can afford to pay more for property. Therefore, you see prices increase in value. Ballarat and Bendigo are certainly that commutable. They are slightly further away, and their population centre isn't as strong. So Geelong's almost 300,000 people. So what does that mean? That's, there's typically going to be more jobs locally in Geelong that pay more because it's a larger economic hub. And if you look at Ballarat and Bendigo, Bendigo's about 100,000, Ballarat slightly more, 125,000. They are smaller economic hubs, therefore the affordability ceiling will be likely lower than that of Geelong because it's a larger district, has higher incomes. But absolutely, there will be people, and there is a large portion of that population that do commute to Melbourne, therefore can afford to pay more when they look at property. So to summarise that, yes, they are metropolitan regional, so to speak, or commutable regionals. Do I think they have the same level of upside as Geelong? No, I think the ceiling in Geelong will always be higher than that of Bendigo and Ballarat, but we will see prices increase, I believe, in the medium to long term in those markets.
Next one is on Darwin, and those of us in the podcast would probably know our thoughts on Darwin. However, we haven't really spoken about Darwin post-budget and with changes and the feedback we're hearing from a lot of investment groups out there is they're still in that market. So it'd be good to get an understanding from your perspective, Lachlan. The question is, would it be possible to have some commentary on Darwin? Is it a good market to invest in? Is your answer the same? So for those that haven't listened, we're pretty against Darwin. Has that changed, Lachlan, post-budget?
We're unbiased, Reece. When you say we're against, we are unbiased to markets, but we're biased towards data. Right, the market, Darwin itself, I've got no problem. In fact, it's quite a nice place to visit. So we're going to be careful about how we frame these conversations. It's not the place that we have against; it's just the data. And a lot of these other buyers groups are pushing. They push projects. So big projects are going to result in increased population. So a gas project is going to attract 10,000 jobs. Therefore, we're going to see incomes rise and population growth is a demand indicator. Then prices increase. So they're pushing this story around population growth. When you dive into the data, it's not a positive population story in Darwin. And so that is my concern. Much like Tasmania. I think you picked up a stat the other day, 76% of the activity in lending in Tasmania is investment lending. That's concerning. The same is true in Darwin. All the activity that's happening there that's driving value is purely driven by investors. And if you're buying into a market that's heavily investor driven, when the fundamentals of population growth aren't strong, so there's, and we know it's a transient location. So what I mean by that, people go to Darwin for a short period of time and may take on a short-term contract and then they leave. So there's typically no permanent nature to a lot of people that go to Darwin. So when I look at the demand indicators, medium to long term, I fundamentally can't support that market. Will it go up in value in the short term? Yes. When we see a lot of investor activity that's generated by a lot of buying groups, we typically see a short-term uptick. So if you can get into that market and get out in a short period of time and understand your entry and exit costs, I would say that market is a big gamble, and we don't like to gamble with people's money, and we don't like to gamble with property. It is a large investment, so you want to be careful with that. And I think there's better opportunities in the country, medium to long term, that have stronger data fundamentals in terms of that supply and demand that underpin that market, so you can go in and get the same amount of upside with less downside risk.
Lachlan, I've got a few more questions to close it off, but let's do some quick fire and just see where we land with those ones. So, quick fire questions: are new builds actually worth buying just for the tax benefit?
No, we don't invest in property to save tax. We invest in property for capital gain, typically over the medium to long term. So, my position on this hasn't changed.
How do I know if a suburb is going to grow?
Track the data, and when demand exceeds supply in that suburb, typically you'll see an uptick. Also, when I say data, look at the local incomes. If incomes are increasing, there's less supply, vacancies are low. Every decision we make around property or tracking to give us an outlook or prediction on a market purely comes down to the data. Infrastructure spending, on average, how many dollars have been spent per person on that particular suburb in comparison to the state or the country. These are the things you need to be tracking.
How long do property downturns usually last in Australia?
Really good question. History tells us, Reece, that property prices double every 10 years. That's not factually correct. In the modern era, it's more like 14 years and can be up to 17 years for regionals. But if you look at a broad brushed rule of thumb, we typically see prices go through a growth phase anywhere from 5 to 7 years, followed by a 3 to 5 year stagnation period. So stagnation periods are typically more short-lived than the growth period itself. But that's an exception to that. Perth is a perfect example that went through a 10-year stagnation, followed by a very short and sharp, as we're seeing now, a 5 to 6 year growth period. So it is market dependent. This
may be different depending on their circumstances. So let's just keep it generic, because I know you'll say, this depends on what your situation is, but just with your experience and the thousands of clients you've helped over the years, how many properties do I actually need to retire on?
A golden figure for a lot of investors, probably 70% plus, that they want 150K at retirement on passive income. With 3 really blue chip properties that are debt free, you can achieve that goal. So then you're like, okay, well, debt free, what does that mean? Means you'd likely need to accumulate probably 4 to 5, noting that you're going to sell down 1 or 2 to pay off the debt on the remaining portfolio. So if you can own your home debt free and 3 investment properties debt free, you will achieve that 150,000 goal. If you're looking at a residential strategy, or it might own your home and 1 commercial property at retirement that's going to pay you that 150,000. That for me is a common strategy for people when they're sort of closing in on retirement.
Last one, and be interested to get your thoughts and if this has changed post budget with the new laws. Should I pay off my mortgage or buy an investment property first?
This looks at this Reece refers to a debt reduction strategy, and a lot of people think best way to pay off my debt is just as soon as money comes in the bank, go straight off the mortgage. I couldn't disagree with that anymore. The quickest way to pay off your debt, and we do this with a lot of clients where we try to pay off their home in 4 to 6 years, is through a debt reduction strategy which looks at buying and selling investment properties to pay off that debt quicker. You look at a standard mortgage, you're paying that off over 25 to 30 years. And you're using after-tax income to pay that off. That is going to take you a long time. It's not the best use of capital. The way I've done it and the way we do it with our clients is I have a mortgage on my home. Hopefully it doesn't make up any more than sort of 3.5 times my income. So that gives me some chips to play with in terms of investment properties. But then by buying 1, 2 or 3 investments and riding the markets and then selling them, I can pay off large portions of debt at any given time in forms of hundreds of thousands of dollars. A $400,000 gain, I can wipe that off my mortgage very, very quickly. Another $300,000 gain, I pay that off. So I think the quickest way to get debt-free is by taking on more debt, which sounds counterintuitive, but that's the reality of a debt reduction strategy.
And for those that want to delve more into that, we did cover that on a podcast with a mortgage broker, Michael Killiner, where he spoke about the changes from how lenders look at offset accounts as well, if you were wanting to put it all in an offset rather than pay it off. Especially if you look at a grow portfolio, it's definitely worth a listen on that one because there is some different strategies out there. That's it. Good wrap up there, Lachlan. For those, I'll mention it again, we have been getting bombarded with Perth updates. I think the market, obviously for the first time in probably since I've been doing the podcast, has started to slow down. So there's a lot of questions out there. We've left a lot of those. We'll wait for when you're back next week, and we'll do a deep dive with Trent Fleskens as well into the Perth property market. You've been listening to the Follio Property Podcast.